Welcome. Today we confront a financial phenomenon I call the Scared Money Index, or SMI. This isn't found in any economic textbook, but it dictates the financial outcomes of millions. The SMI measures the cognitive bandwidth and emotional energy you dedicate to safeguarding cash versus the time you spend strategizing its growth. If that protective effort significantly outweighs the generative effort, you are, by definition, suffering from a high SMI. This fear-driven defense mechanism, often masked as prudence or responsibility, is perhaps the single greatest impediment to building substantial long-term wealth. We must understand that in the relentless landscape of modern economics, merely protecting cash is not security. It is a guaranteed slow decline. The game of wealth is not played by standing still, but by intelligent deployment, which requires a fundamental shift in how we perceive risk and safety. Let's debunk the illusion of safety. For many, seeing a large balance in a checking or low-yield savings account provides a profound sense of comfort. This comfort, however, is deeply misleading. While your principal might be protected from market volatility, it is relentlessly exposed to the unseen yet aggressive risk of inflation. Imagine inflation as a pervasive silent tax on stagnation. If inflation hovers at 4% and your cash account yields 0.5%, you are functionally losing 3.5% of your purchasing power every single year. You are spending your time safeguarding a shrinking asset. The mental comfort of liquidity becomes a financial liability. Wealth builders understand that the greatest loss is the loss of opportunity, and the greatest risk is letting capital erode passively when high-quality assets are available for deployment.
The mathematical weight of the Scared Money Index is staggering when viewed through the lens of compounding. Consider two individuals starting with the same capital. Individual A, exhibiting a high SMI, secures their money in ultra-safe instruments, earning 1% annually, focused purely on capital preservation. Individual B accepts strategic calculated risk, aiming for a modest 8% return. After 20 years, the difference isn't linear, it's exponential. Individual A's wealth has grown marginally. Individual B's wealth has potentially quadrupled or more. The cost of inaction isn't just the few percentage points you missed this year. It's the compounding returns those percentage points would have generated over decades. This is the opportunity cost multiplier, and it's the definitive metric that proves that protecting cash often means losing the ultimate wealth game.
This fear is rooted in fundamental behavioral psychology, primarily loss aversion. Nobel laureate Daniel Kahneman found that the pain of losing $100 is psychologically twice as potent as the pleasure of gaining $100. When applied to investing, this means the fear of temporary market volatility, the idea of seeing your portfolio drop 5%, drives irrational decisions, often leading people to retreat to cash. The high SMI environment is self-perpetuating. Because they pull out during dips, they miss the subsequent rebounds, reinforcing the negative belief that investing is too risky. To reverse the SMI, we must first accept that short-term volatility is not the same as permanent capital loss. Growth necessitates absorbing temporary fluctuations. Managing money strategically requires managing our emotional reaction to those fluctuations.
The core shift required is moving from a scarcity mindset to an abundance mindset. The person with a high SMI views money as a finite resource that must be defended against predators, be they market downturns, poor investments, or economic uncertainty. Their primary concern is minimizing loss. In contrast, the wealth creator sees money as a tool, an engine that must be maintained and deployed to generate new resources. They focus on maximizing potential returns, understanding that some losses are simply the cost of doing business and learning. We must change the internal dialogue. Stop asking, how do I ensure I don't lose any of this? And start asking, how do I ensure this capital is working as hard as possible for me? This is the critical transformation from a defensive saver to an offensive investor. To illustrate the fallacy of extreme protection, consider historical data. Let's look at two critical periods, the 1970s and the early 2000s. During the 1970s, high inflation decimated the purchasing power of cash holdings. While interest rates rose, they rarely kept pace with the sustained double-digit inflation. Those who pulled out of productive assets and waited for the right time found their stagnant cash was eroded by 50% in real terms over the decade. Similarly, following the Great Recession of 2008, many individuals remained on the sidelines for 5 or more years, fearful of another crash. They missed one of the longest and strongest bull market runs in history. The lesson is clear. Long periods of cash hoarding, driven by the SMI, consistently deliver negative real returns. The market always moves forward, and those parked on the sidelines inevitably fall behind.
So, how do we hack the Scared Money Index? The first strategic step is implementing sophisticated mental accounting. You need to clearly and rigorously define 2 separate pools of capital, the protection pool and the growth pool. The protection pool is your true emergency fund, liquid, 6 to 12 months of expenses, held in the highest yielding savings account or short-term T-bills for security. This pool is sacrosanct and provides the emotional safety net required to eliminate SMI anxiety. Everything beyond this defined threshold belongs by strict policy in the growth pool. By clearly delineating funds, you remove the emotional burden of uncertainty from your investment capital. When the market dips, you know your essential security is untouched, allowing you to view volatility rationally, perhaps even as a buying opportunity, rather than a threat to survival.
The second powerful hack is the removal of the human element through automation. High SMI is fueled by analysis paralysis and emotional decision-making. The simplest way to neutralize this is systematic automated investing. Set up recurring transfers that move money directly from your paycheck or bank account into your chosen investment vehicles, index funds, diversified ETFs, or retirement accounts, the moment your protection pool threshold is met. By automating the contribution, you remove the emotional pressure of deciding, is today the right time, or is the market too high? Dollar cost averaging, applied systematically and without human intervention, becomes a disciplined countermeasure against the short-sighted fear that defines the Scared Money Index. Consistency, enforced by automation, crushes the anxiety of timing the market.
We must internalize the exponential nature of growth. The Rule of 72 provides a visceral reminder. Dividing 72 by your expected annual return tells you approximately how many years it will take to double your money. At 2%, doubling takes 36 years. At 8%, doubling takes 9 years. The time difference is colossal. This rule highlights that the greatest asset you possess is not your starting capital, but the time horizon you have for that capital to compound. Every year you keep significant resources hostage in stagnant accounts, you are deliberately forfeiting multiple doublings. Shifting your focus from the linear accumulation of savings to the exponential growth of invested capital is the philosophical cornerstone of reversing a high SMI. Wealth is not about accumulating currency. It is about owning assets that appreciate and generate income while you sleep.
Finally, we must redefine risk itself. For those trapped by the SMI, risk is narrowly defined as market volatility. But for the sophisticated investor, true risk is the failure to meet long-term financial objectives. If your goal is retirement by age 65 with $2 million, but your high SMI forces you into accounts yielding 1%, the risk of you failing to reach that target is astronomically high, regardless of how stable your capital remains along the way. The riskiest action for a young or middle-aged person is not engaging with productive, diversified assets. The riskiest action is financial stagnation. Embrace strategic risk, which means risk that is diversified, manageable, and aligned with a clear long-term goal. Understand that measured uncertainty is the price of admission to real wealth creation, while certainty of preservation is the recipe for guaranteed mediocrity.
The implementation strategy to permanently lower your Scared Money Index starts small. If the idea of investing 50% of your excess capital causes anxiety, start by committing just 5%. The goal is to build muscle memory around deployment, not protection. Every positive experience, no matter how small the contribution or return, chips away at the fear. Educate yourself relentlessly. Knowledge is the ultimate antidote to financial anxiety. Understand the difference between speculation and investment. When fear inevitably arises during market dips, reference your defined protection pool and remember the historical context that over any rolling 20-year period, diversified, patient investors have consistently outperformed cash holders. The path out of the SMI is paved with small, consistent, automated steps forward.
The Scared Money Index is a self-imposed limitation. It's a measure of where your financial focus lies, defense or offense. True wealth is not measured by the size of the cash cushion you have desperately guarded, but by the velocity and efficacy of the capital you have wisely deployed. Take control of your financial narrative today. Stop calculating hypothetical losses and start planning for guaranteed growth. Redefine safety as the achievement of your financial goals, not the preservation of nominal value. Break free from the paralysis of protection and step onto the field of strategic investment. If this video has challenged your perspective on savings and growth, we encourage you to share your thoughts below. Don't forget to like and subscribe for more updates on financial psychology and wealth strategy.